Picture two people. Same salary. Same savings. Same opportunity. Subject A opens a brokerage account, puts money into index funds, and lets time do the work. Subject B? He stares at the same screen and closes the tab. The market feels like a maze with no exit, so he leaves his money sitting in a savings account, slowly bleeding value to inflation. Same resources. Completely different outcomes. What separates them isn't willpower, income, or risk tolerance. The answer is buried deeper in how the brain processes complexity. Today, we're going to show you how your ability to handle numbers and language quietly decides whether you enter the market at all, and why being very intelligent doesn't protect you from the most costly mistakes investors make. For years, economists were puzzled by what they called the participation puzzle. Millions of people could invest, they had the money, but simply didn't. Why? Researchers Demetrius Christelis, Tullio Jappelli, and Mario Padula dug into data from the Survey of Health, Aging and Retirement in Europe, tens of thousands of households across the continent. What they found wasn't about income or education in the traditional sense. It came down to three very specific cognitive abilities. Numeracy, can you calculate a percentage in your head? Verbal fluency, can you name 20 animals in 60 seconds? Recall, can you remember a short list of words after a brief distraction? Move any one of those skills up by a single standard deviation, and the probability of that person investing in stocks jumps by 6%. Here's why that matters: these skills don't predict whether someone is smart. They predict how much mental energy it costs to process financial information. If reading a fund prospectus feels like translating a foreign language, your brain will find a reason to skip it. The perceived cost of engaging becomes higher than the perceived reward, and you walk away. The barrier to investing isn't always money. Sometimes it's friction in the mind. Now, let's say you're already in the market. Does raw intelligence actually translate into better results? Researchers Mark Grinblatt, Matti Keloharju, and Juhani Linnainmaa tackled this with a dataset most researchers only dream about: 158,000 Finnish men, each with IQ scores recorded during mandatory military service, cross-referenced with their actual investment behavior over years. The results were striking. IQ turned out to be a stronger predictor of stock market participation than income itself. But beyond entry, higher IQ investors also tended to hold more diversified portfolios, experience lower volatility, achieve better Sharpe ratios, more return for each unit of risk, and avoid the classic mistakes that quietly bleed portfolios dry, concentrating everything in a single stock, paying unnecessary fees, chasing yesterday's winners. Even among the wealthiest participants, those with lower cognitive scores participated less. Which proves the point: this isn't about not having enough money. It's about the mental effort required to navigate complexity. Here's where it gets uncomfortable. If cognitive ability helps you enter the market and build a better portfolio, you might assume it also protects you from psychological traps. You'd be wrong, and the evidence is surprisingly clear about it. Keith Stanovich, Richard West, and Maggie Toplak have spent years studying what they call Myside bias, the tendency to evaluate evidence in a way that confirms what you already believe. You look for information that supports your thesis. You dismiss what challenges it. You remember the data points that fit your narrative and forget the ones that don't. And here's the uncomfortable finding: the magnitude of Myside bias has almost zero correlation with IQ. In experiment after experiment, high IQ individuals were just as likely to ignore contradictory arguments as everyone else. In fact, there's a cruel twist. More intelligence can make the bias worse. A sharper mind is better at constructing sophisticated-sounding justifications for a belief you're already emotionally attached to. If you're convinced a crypto project or a tech company is going to change the world, your intelligence won't save you from the warning signs, it'll help you argue past them. Intelligence helps you process data. Rationality, which is a different thing entirely, is what stops you from lying to yourself. So what do we do with this? Stanovich's research offers a real clue. High-IQ individuals only avoided Myside bias consistently when they were given an explicit instruction to detach, to deliberately step outside their own perspective before evaluating evidence. 3 evidence-based practices you can apply starting today. 1. Active detachment. Before you buy or sell, write down 3 serious reasons your investment thesis could be completely wrong. Not to talk yourself out of it, to stress test it. Think like the opposing attorney. Put it on paper. The act of writing makes your brain treat it as real. 2. Outsource the numbers. Because numeracy is a genuine barrier, don't trust your intuition on percentages. Use tools and algorithms to automate portfolio rebalancing. Reduce the cognitive load so friction stops becoming an excuse. 3. Seek out disagreement. The Christelis study found that social interaction amplifies cognitive ability, but only if it introduces genuine diversity of thought. Talk about your investments with people who think differently. Not to argue. To break the echo chamber before it costs you. Intelligence is the tool that gets you into the market. Cognitive humility is what keeps you from giving it all back. Have you ever held onto an investment, not because the number supported it, but because admitting you were wrong felt worse than watching it fall? Tell us in the comments. And tell us whether you found a way out. Subscribe to Brain&Cash for more evidence-based analysis of the forces that actually move your moan.